words come to mind when someone says taxes? Boring? Tedious? Difficult? Obscure? Confusing? Complicated? Mind-numbing. The details of the 73,594-page tax code can be all of those things. However, tax planning for better returns on your investment boils down to 3 factors: rate, timing, and deductibility. First, I'll explain what each of these is and then demonstrate how you can keep more money in your pocket. Rate. Rate is the percentage at which you are taxed. Paying taxes at a lower rate leaves you with more money in your pocket. Assume you bought shares in a company and have earned money on your investment. You'll have to pay taxes on the money earned. If you received cash from the company, what people call a dividend, you could be taxed as high as 20%. However, if you earn the money because you sold the shares at the end of the year, you have what we call a short-term capital gain. In that case, you could walk away with a lot less because short-term capital gains tax rates can go as high as 40%. Now, timing. Timing is based on the principle called the time value of money. As long as your tax rate does not go up, the longer you can delay paying taxes, the more money you will have at the end. Let's assume you earn 10% every year for 10 years on a $1,000 investment. If you received your return as a cash dividend, paid 20% in taxes every year on the return, and continued to reinvest the money, your investment would grow to over $2,100. If the company doesn't pay dividends, but the stock price increases by 10% every year, no tax consequences occur, and your investment grows to almost $2,600 in 10 years. When you sell the stock at the end of the 10 years, you have what we call long-term capital gains rates, which are taxed at 20%, leaving you just under $2,300. In this situation, you pay the same tax rate as when the return was paid as a dividend, but you end up with more cash in your pocket because you don't pay the taxes for 10 years. So, you are worse off when a company pays a dividend because you lose the ability to earn money on the cash taxes that you pay to the government. Finally, deductibility. Deductibility is the ability to deduct the cost of your investment on your tax return. When you deduct your investment, you reduce your taxes and have more cash to invest. Let's go back to the investment of $1,000. If you can deduct your investment in the stock, you will be able to reduce your taxable income by $1,000. If your tax rate is, say, 20%, this deduction will save you $200 in taxes. It is as if the government contributed to your investment by providing an extra $200. Every tax plan, no matter how complicated, boils down to at least one of these 3 factors. Many contain all 3. So let's see how much we could earn without considering rate, timing, or deductibility. This time you're going to invest $1,000 in a bond that is not deductible, earns 10% in interest every year, and you pay taxes on the interest at 30% every year. At the end of the first year, you will have $1,070. If you continue to reinvest for 10 years, you will have over $1,900. However, if you get a deduction because your $1,000 investment in the bond was put into an individual retirement account or an IRA and your tax rate is 30%, you actually have $1,300 to invest, $1,000 from you and $300 from the government. If you don't pay taxes on your 10% return for 10 years because the tax consequences are deferred on investments in an IRA, you will accumulate over $3,300 before paying taxes. If you sell the investment and distribute the cash from your IRA when you know your tax rate will drop to 15% in 10 years, you will have over $2,800. Voila! You have just earned $900 extra by investing in a bond through an IRA and withdrawing the money when your tax rate drops. Whether you are simply using an IRA to invest or engaging in complex transactions, don't let the details intimidate you. Simply remember that the government is your silent partner in all investments that you make, And your share of the partnership profits is affected by 3 factors. Rate. What percentage of the profits do you have to pay your partner? Lower is better. Timing. When do you have to pay your partner his percentage of the profits? Later is better. Deductibility. Is your partner willing to contribute to the investment? Yes is better.